S&P 500 Index, SPX, daily and weekly chart analysis. November-December seasonal rally continues. In this video, we will analyze the long-term chart of the S&P 500 Index, SPX, and discuss the current market conditions. We will also explore the factors influencing the market, such as credit card debt, interest rates, and home affordability. Additionally, we will provide an overview of the recent economic reports released in the U.S. Based on our analysis, we maintain a bullish position on the SPX. S&P 500 Index, SPX, chart analysis. Last week, the SPX recovered most of its recent losses, indicating a potential bullish entry point. The conservative S&P 500 strategy, which is designed to protect investors from bear markets, exited to avoid further risks. However, the current gains suggest that the risk of a bear market is non-existent. The rally has shown promising signs of continuation, with an upside breakout in the SPX and the Nasdaq 100 Index, NDX. Follow-through is crucial, as an upside breakout followed by losses could lead to failure. The powerful rally after the breakout is a bullish indicator, and the holiday period of November through December is known for advancing equity markets. Short-term selling may occur, but it is likely to be followed by more buyers entering the market. Resistance is expected at SPX 4,540, the August-September rally high, and breaking through that level could lead to the prior July highs becoming the next target. Credit card debt and delinquencies. The country's credit card debt burden reached a new record high of $1.08 trillion in the third quarter of 2023, according to the Federal Reserve Bank of New York. This represents a $154 billion increase from the same period in 2022, the largest year-to-year jump since data collection began in 1999. Delinquencies are also on the rise, with the share of newly delinquent credit card users reaching 2% in the third quarter, the highest rate since at least 2015. Interest rates and home affordability. Futures traders are pricing in a 100% probability that the Federal Reserve will leave interest rates on hold after their final policy meeting of the year next month. However, they are pricing in at least 4 rate cuts by the end of the Fed's December 2024 policy meeting, with expectations for a fifth cut increasing to nearly 23%. Meanwhile, the income of a typical homebuyer in the United States surged to $107,000 from $88,000 last year, making homeownership unaffordable for many families with a median income of about $75,000. Recent economic reports. Several economic reports were released this week. The U.S. trade deficit widened to $61.5 billion in September, imports rose by 2.7%, and exports increased by 2.2%. The rate for 30-year fixed-rate mortgages reclined to 7.61%, the lowest in 5 weeks, and mortgage applications rose by 2.5% after 3 consecutive weeks of declines. The number of Americans filing for unemployment benefits fell to 217,000, but continuing claims rose for a 7th week to 1834,000. The University of Michigan consumer sentiment fell to 60.4 in November, the lowest in 6 months, and inflation expectations increased for the year ahead. Conclusion. The November-December seasonal rally continues to push prices higher in the SPX. Based on our long-term chart analysis, we maintain a bullish position. However, it is important to monitor market conditions and follow through after upside breakouts. Factors such as credit card debt, interest rates, and home affordability can influence market dynamics. The recent economic reports provide insights into the U.S. trade deficit, mortgage rates, unemployment claims, consumer sentiment, and inflation. As always, it is crucial to stay informed and make investment decisions based on a comprehensive analysis of the market.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.